Well, I know they recently announced that they have concluded about 13 out of 99 initiatives. I mean, they haven't listed exactly what and what has been done. So we still have a long way to go, but at least we've seen a few things happen over the past few years. We know the master plan about how to deepen the market, how to look at basically what's happening in developed countries, developed capital markets, and basically try and mimic that and try and see how we can boost things like liquidity, effectiveness, market regulation, and co. within the Nigerian capital market space. So if you start to look at little things that they've done, for instance, you have the materialization. You have electric credit of dividend. So nowadays, if you don't register your dividend, e-dividend, then you don't get anything. Then we had the recent one where they're talking about margin lending, which goes towards their trying to deepen the capital market, because they're trying to create a capital market where you can ensure that they can fund almost any transaction size that you have locally, rather than always having to go offshore to get funding. You also recently have them talking about derivatives. You've had recently had a derivatives workshop where you had the central bank, FMD, FMDQ coming together and talking about how to deepen and develop the derivatives market.
So for you, I mean, looking at across all that's been done,
yeah.
13 so far, which would you say have been the most significant, especially in terms of the impact it's had on the market?
I think I'll say they've all been significant. The e-credit has been pretty significant. The materialization of all your securities has been significant. It makes it so much easier and creates a lot more confidence for people. Gone are the days where you're chasing your broker to credit you with your dividend when it's paid. Gone are the days when you have unclaimed dividends. Once your account has been registered, you just know that on that day, the money automatically flows to you. It makes life so much easier. I think a big part really would be derivatives, because I still think that is one place that Nigeria is really lagging behind. Hedging instruments, hedging tools.
But we've been talking about it for quite a while now. What would you say? I mean, what are the barriers that still remain?
I think one of the truth about it that a lot of your derivative products are built off interest rates. If you're looking at be it swaps, futures, even when you go into equities, a lot of things require take into consideration cost of funds. So a lot of them are built around interest rate and currencies. And as long as you continue to have huge volatility, huge swings in your interest rates, and you have huge swings in the currency, people are a bit reluctant to go into that market. Why? Because you can get your head shaved overnight. When interest rates or your bond yields go from, say, 16 to 14 in the space of 2 months, and you basically sold a hedge to someone, and you're losing 200 basis points on a 20-year bond on a large volume, you could go out of business. So I think to a large extent, being able to manage interest rate volatility swings and also being able to stabilize the currency, when people can plan, then you start to see people a bit more comfortable selling these hedging tools.
Now, how would you compare or assess Nigeria with our peers on the African continent? Looking, I mean, the Johannesburg Stock Exchange, Egypt, Kenya, how would you say we're doing?
Well, I think those countries have a lot more in terms of derivative products than we do.
No, overall, not just derivatives,
yeah.
overall.
Okay, overall, I would say,
growth.
I mean, in terms of size, we're trying in terms of capital market size, but in terms of liquidity, really, because Nigeria is basically the go-to market. So if you're investing in Nigeria, South Africa comes first. And after South Africa, the next country to look at is Nigeria, naturally because of the size of the economy. We still have some way to go to deepen the capital market. In terms of currency, we still have some way to go in comparison with some countries, especially when you're looking at South Africa and even when you're looking at Egypt, what they've done recently with their currency. We still have some way to go with regards to being able to free up our currencies. We still have some way to go.
You're talking about, I mean, the multiple segments that we still have?
Yes. So we basically still have some work to do, but I would say Nigeria would still come first, and maybe Egypt, and then, South Africa first, Egypt, and then maybe Nigeria. Okay.
Let's quickly talk about this margin lending that the SEC wants to revisit. I mean, the rules, I mean, remember the boom just before the market crash in 2008. It was quite a boom. And then, of course, the crash, and so many people had their fingers burnt. And, of course, the rules from then 2010 were very stringent. But now there's talk about a review. What can we expect? I'm just thinking, how much leeway or how much loosening can happen with those rules to allow people to take a few steps in and see how it could benefit them?
So, I mean, first of all, I think it's a good step because you want to get a bit of liquidity into that market and try and get the retail people. The major thing has to be around regulation, which is one of the plans for their market master plan over the next 10 years. You have to ensure that you are going to protect the retail investors, the investors who are not so savvy, because the last thing you want is to have another boom and bust. Then, I mean, you still have people licking their wounds still today. I had a chat with someone yesterday who talked about throwing away share certificates, that is still disenfranchised, anything stock market, they had absolutely no interest.
Still pointing to that 2008,
still pointing to that. Yeah, so a lot of people actually got their fingers burnt heavily. So you need to, and they need to bring in regulation to ensure that what happened then doesn't happen again. And one of the major issues we had then was pointed towards share manipulation. So people are going to have public offers. They would come in, buy up their shares, push up the price. The retail investors were going to buy. Then once the funding went out, it felt like a pack of cards. So you need to ensure that those kind of things do not repeat itself.
But would you say that where the NSE is, where we are today, especially the NSE as the regulator, has evolved and come a long way in terms of, corporate governance and just that oversight over the companies, over the markets, ensuring that we're at a place now where for that to happen, it will be really difficult?
Definitely, I agree. But we know how greed can set in and everything turns around. But I think if you think about the issue we had with Nnamdi, you would say some years ago you wouldn't have anybody questioning Nnamdi and trying to ensure that they are doing things the right way. So we are evolving. We are still not where we should be, but we are gradually improving. They are improving their regulatory oversights. They are beginning to question people. They are beginning to sanction organizations. We've seen SEC slam fines on so many people for not. We've seen the NSE suspend shares from the exchange for not releasing their financials on time. So you have the regulators beginning to wake up to a lot of these things, but they will have to really be on their toes. Because one of the challenges you have with regulators is being able to keep up with the market. So you don't want a case where, the market operators are normally way ahead of the regulators. So if I come again with, and people find some loophole, they find some way to go around and manipulate their shares, and then you have people stuck, holding the short end of the stick once again.
So if all of this is implemented, the master plan itself, what shape would the market have? What would be significantly different? I know that over the years, like you said, all the changes that have been made have helped shape the market to where it is and what it is right now. But in a bigger picture down the line, with all of that, in the bag, all implemented, what would we look like?
Well, it's a pretty good and robust master plan. When you go through it, you see that they've actually identified the issues, and they're able to address all the issues, or most of the issues that I mentioned. You definitely have a very liquid market. You have regulators who are more up to date. The best kind of regulator you can get are people who are market operators.
I thought that was always, that's usually a work in progress. Do we get to a point where one can say a regulator is, always that one or a couple of steps ahead of?
No, but at least you can get to a place where you said regulator is not too far behind. Where the regulator, to a large extent, understands your products. So even if you go to the pension funds, for instance, and you're saying to them, I want to do a repo, which is basic, right? You still have PenCom saying, no, don't do repos. So when you get to the point where regulators are up to speed. So if they do that, then you're talking about, they talk about deepening the market, they've talked about efficiency in the market. If they achieve all those things, then I think we'll definitely be able to catch up and even overtake South Africa.
Nnamdi, thank you so much for your time today. We appreciate your time.
You're welcome.